Hello, everyone. Welcome to Wall Street for Main Street's podcast. My name is Mo Daoud, and today's special guest is returning guest Jeff Desjardins. He is the president of the Tickerscores.com and also the founder of the Visual Capitalist. And also joining him is Andronyk. He is a mining analyst from Tickerscores.com. Jeff and Aaron, thank you for joining me.
Thanks for having us, Mo. Great to be here, Mo.
Now, for our listeners that don't know much about Tickerscores, could you guys give us a little summary of what your newsletter does and how you guys analyze the commodity and energy stocks under your Tickerscores newsletter?
Yeah, definitely. The first thing that I would say is that traditionally the industry has been set up such that retail investors don't really have a place to go to have objective, independent, and empirical information on precious metal stocks or other junior resource companies, just because of the way that the space is and the nature of the companies being, micro cap or small cap companies. So what we decided to do is try and create a much more transparent system that's based only on quantitative data, so using numbers from reports and metrics about the management team, as well as anything else that we could factor in that's empirical based on how we rate companies to create an objective indicator to investors of whether a company is worth looking at further or not. So we've created a system that basically uses 20 plus quantitative variables to judge each company, and we compare them all against one another, and it spits out a score out of 100 points to show how the company rates. So you can think of it as like a credit rating system, except for companies, for an investor.
And how did your analysis of mining stocks differ than what you see from traditional analysts out on Wall Street, where they do discounted cash flow and other valuation methods? But you guys don't actually evaluate how much just you think the stock is going to be. You just evaluate their financial statement and management team and their assets. Is that correct?
Right. Well, so the first thing that you have to keep in mind is that from the discounted cash flow perspective, stuff like that makes sense for majors and companies that are creating revenue. But the majority of these junior miners, what they're really doing is they're exploring, they're drilling, they're proving up a resource, and for all intents and purposes, until you get really to the PEA stage, or until you even get to the feasibility stage where you're actually looking at the engineering and stuff, you have no idea how much revenue you're going to be able to create from these projects. So you kind of have to look at them a little bit differently. And luckily, there's most of these companies are all operating under the same framework that allows you to compare them fairly directly. But with our analysis, we basically break it into 4 different categories. We're looking at the management team, we're looking at the project, we're looking at sort of the relative performance, and then we're also looking at their financials. So we take those different things. We have about 5 or 6 different variables that we use in each of those analyses, and that's how we spit out the score. So it is a little bit of a different method because, especially when you're looking at newsletter writers, these guys, when they pick companies, it's a little bit arbitrary. They're not really basing it on some sort of overall comparative framework. And if they are, they're not usually telling investors what that is, like how they decide on companies exactly. So it's kind of arbitrary. And basically what we're trying to do is we're trying to bring all this information to the people so that they can actually see how we rate things, why we rate them that way. We give them all the variables and the data that we used so that people know that it's objective and transparent, and then we show the results as well. So it's a different model for sure, but I think that the biggest difference that we can ascribe is that in the past you didn't have the power of big data to do stuff like this. You weren't able to input all this stuff into a database and look at how everything relates to one another and find trends that way. So, it's not something that you're actually able to even do 15 years ago. So that's why we're able to do it now, and it's sort of a more modern approach.
Yeah, and picking out commodity stock, I think is very difficult because you gotta have a little bit technical understanding of how to interpret drill results and also how to interpret the assets, the reserve and the resources and etc. Whether it's for gold, silver, or any commodity stock, you got to understand a little bit of that, and then also you have to understand the management team, what kind of management team they have out there, and what I find out there that finding a good management team is rare in the commodity sector because a lot of them mismanage their capital and their asset, and because they were betting on higher commodity prices, they poorly planned how to develop the mine, and look what happened when commodity prices dropped out of nowhere. A lot of them went bankrupt. So I think investors, especially on Main Street, are looking for something that's easy for understand, and looking especially in the commodity sector because it's very difficult.
Yeah, there's definitely an educational aspect in there as well. As you mentioned, you're talking about management teams, mismanaging their funds and things like that. That's one thing that we're trying to do as well. Is we're trying to educate the sector on these types of things, like even just being able to, as a regular retail investor, to be able to understand something like G&A and being able to look at where money is going within a company, because a lot of people don't get into that depth where they're looking at that kind of information. But when you're armed with data and you're able to look at sort of the averages across the industry and what people are doing and compare it to other companies, which is sort of how we approach it, you can actually see if a company is doing good or bad on that front, to see if they are creating opportunities for shareholder wealth, or if they're spending all of their money on hotels and expensive lunches and things that aren't going to create opportunities for share price appreciation.
So let's talk about the gold and silver sector, especially the stocks. Aaron, with the gold and silver prices this low, how are the mining stocks holding up lately? Because I think there are a lot of them are pretty close to going bankrupt, shutting down their mine again. Because I don't think anyone expected gold and silver prices to be this low for this long. Especially myself, I didn't think it would be this low forever.
Yeah, I agree. I think it caught a lot of people off guard, and especially a lot of the miners, specifically the primary silver miners. I think they're hurt the most. About 75% of silver produced is actually as byproduct. So a lot of the miners producing byproduct silver, it's not really affecting. But the primary silver producers, for sure, they're having a tough time at these levels. A lot of the primary silver miners as well, they went into development programs over the last couple of years, trying to expand their operations when the silver price was higher. So that's a lot of capital going into that, a lot of capital intensive programs. So now they're finally coming out of those programs into a soft market here, and we'll probably see an increase in production going forward because of the expanded operations at all these mills. But I think as far as the price goes, from what we gathered at the Silver Summit this week, some of the key analysts were mentioning they think we're bottoming out around $17, and they expect silver to trade in a near term in a range of a low of $17 to a high of $21.
And with the high demand in the East, gold and silver prices can't stay this low forever. So, I mean, the fundamental is stronger than it's ever been. If you look at the sales for the mint, gold mints, the gold, silver, hold on, let me rephrase that. If you look at the demand in the East, especially China and India, and also look at the mint sales, it's all-time high, month after month. So the price of gold and silver can't stay this low forever.
No, absolutely not. And another thing we gathered while at the Silver Summit was the CPM Group. They believe over the next 10 years, investors will be acquiring over 1 billion ounces of silver, which is which should very well support the price going forward.
Yeah, it's also worth noting that silver investment is the primary source of it's the primary factor in terms of silver price. So there's been different periods of time where people are, I guess, getting rid of silver, and different periods of time where people have been buying silver, sort of from that standpoint. And we're in one of those times where people are accumulating silver. So eventually that's going to be reflected back into the price and demand.
Yeah, definitely. I mean, if you look at what China and Hong Kong did last year, I mean, there's reports out there that they acquired an annual mine supply of gold. I don't know if that's accurate or not, but if that's true, then, I mean, no way gold and silver can stay this low forever. And so we'll see what happens in the next, maybe 2015 will be the year. Go ahead.
Yeah, even imports into China. I think gold had reached, there's an announcement today or within the last couple of days that gold reached 5-month highs in terms of importing gold through Hong Kong. So, I mean, this demand is going to be staying for the foreseeable future here, if not growing with the size of their, with Chinese wealth growing and also with Indian population growing. I mean, those are two factors there that are very bullish in the long term.
And that's a great point. And also in India, gold is a big part of their culture. So, I mean, when they have wedding season and stuff like that, I mean, the demand for gold is always high in that country. And so when you guys analyze the gold and silver mining stocks, what do you think the biggest challenges that these mining companies are going to have going forward, other than trying to battle low gold and silver prices? To me, I think it's going to be the rising energy costs that they have to deal with, because they use those giant haul trucks to haul all that gold and silver and whatever commodities they're carrying. And I don't know if you've seen those tires on those haul trucks, but they're huge. And I read somewhere that the tires actually cost more than the truck itself, and they have to replace it every once in a while because of wear and tear. So I want to get your guys' input on what challenges do you think gold and silver mining stock will have going forward, other than battling low gold and silver prices?
Yeah, those tires are about $50,000 each, and they burn through them. They wear through them quite quickly. So there's a lot of tire replacement through the life of a haul truck. So yeah, for sure, big expense. As far as energy goes, it's a good point. It's something I think about often too. We have oil right now though at $80 a barrel, and it's retraced from over $100 not so long ago. So in the short term, it seems that perhaps operations will benefit from a falling oil price, but who knows what that price will be going forward. But that's definitely a key component in operations, in operating expenditures.
Yeah, I mean, the single biggest factor, I don't know if I look at energy prices as being the thing. I mean, there's rising costs in all kinds of different areas for these guys. Like if you look at how their costs have changed from 10 years ago till now, everything's more expensive. Labor's more expensive. Exploration, I mean, if you look at exploration expenditures, it's insane. The amount that you have to explore now to find something compared to back then, that's really high, which means that the value of a good deposit is increasing as well. So if you're going to do M&A and you want to buy a good deposit, that's going to cost you a lot of money too. So there's all kinds of different cost profiles that have increased over the last 10, 15 years. Energy is obviously one of them, but basically if you're a miner, everything is more expensive nowadays. Even look at the sort of corporate sustainability and stuff like that. I mean, a long time ago, it didn't matter if you had these kinds of programs, if you were doing all these things to get benefits back to the community and create these different investments that you have to make through with governments and things like that. And nowadays, it's practically expected. They're expecting you to build that new power plant, or they're expecting you to take all these precautions and stuff. And so it's a different environment there now, and there's lots of costs that have increased along with energy.
And that's a great point there. And you mentioned M&A, merger and acquisition. Are you guys surprised of the lack of activity in merger and acquisition? I mean, we saw a few mergers and acquisition, but we didn't see as many as we expected when gold and silver prices went down. So are you guys surprised?
Yeah, there's been a couple of moments there where I felt like it was going to start picking up. Like the beginning of this year, the battle over Cisco. I thought that was going to be a moment that was going to sort of spur some things. And then at the beginning of the fall here, I thought it might pick up again as well. But yeah, overall, it's as the price keeps on seeming like it's dropping and hasn't quite bottomed yet, or it goes up and then back down. I just don't know if some of the majors are confident yet to make those acquisitions. And then, of course, the other problem is that they're still all dealing with all these write-downs and things that they've had from the past couple of years. And so they're trying to sort out their own stuff first. And I imagine that the corporate mandate at a lot of these big companies is, okay, we got to sort out all of our current projects. We got to start getting our all-in costs down. We got to figure out how we're going to be funded going through the next few years here if prices stay low. And then once you figure out all those things, then you're like, okay, well, what kind of projects can we add to our pipeline? So it's just a matter of all of that coming to a head. We know that when you're looking at the supply of these things, we know that we did an analysis at the beginning of the year looking at how many gold deposits that mid-sizes and majors have, what proportion of those projects are in production, and which proportions are not in production. And if there's one thing that's very clear from that data, it's that they're going to need to replenish reserves very soon. It's just a matter of when they go out and start doing that.
I saw one rumor out there with the Barrick and Newmont rumor that they're might merge, and the Newmont CEO was open to that, but nothing really materialized from that. But I thought that would have been an interesting move if they actually merged, but not sure that's going to happen.
Yeah, hard to say. I don't know. I think Barrick needs to clean up their balance sheet before something like that would happen.
Yeah, I think Barrick, out of all the senior producers, is one that I dislike the most because of the reasons you just mentioned. So looking at the gold and silver space, where do you guys see the most value in right now? Do you, for Main Street investors that want to get in right now, do you think they should look at exploration companies or the junior mining companies or maybe the senior producers?
Yeah, that's a great question because I think that there's a lot of right now we're in a market where we really need to pick companies very carefully and you need to heavily scrutinize them. And right now there are a lot of opportunities on all those different scales, and part of it just depends on what your sort of risk profile is. I mean, I think that there's some explorers out there that, assuming that you can stomach it and you can hold on to them for a long time, I think there's a few explorers out there that could really be on to big things, but you just might not see the results right away. That's sort of why in our last top 10 report, we stuck with a lot of development companies. Companies that you know have ounces in the ground, you know that they have already made progress up to the point that they're at where they have a big resource. Companies that have low CapEx projects that can potentially be produced in this environment. So there's a lot of those out there, but they're still not really showing the true value of the projects just yet because of the lower prices. But a lot of these companies are very highly leveraged to the gold and silver price. So assuming that prices even go up $100 from where they are today in gold, these companies would have much more drastic increases in their share price than the 10% increase in gold would have. So that would be the sort of, I think as an average retail investor, I think that's sort of one of the easiest places to look because you're able to track down a company that's proven resources. You can tell that they have a good management team because they've been able to bring it that far, and a lot of these guys have discovered deposits before. A lot of these companies will be decently funded. So all those things are in place. It's just a matter of waiting for that next catalyst, or waiting for it to go into production, or waiting for the prices to go up. So I think that's the easiest spot as a retail guy to find value. When you look at the explorers, it's a little bit more difficult for your average person, because you have to be able to really understand the geology of these things. And to be honest, a lot of the geologists working on the projects don't understand the geology of these things. So how are we supposed to do a better job than them, right? So it's not easy at all. But there definitely are some ones out there that, we're looking at that are, hitting high-grade holes, and they're still trying to understand the systems that I think have really high potential. It's just a matter of getting in them at the right time and picking the right ones. What do you think, Aaron?
Yeah, I agree a lot with what Jeff just said. And one thing with explorers, absolute geology is very difficult to understand for investors, never mind geologists. But one thing investors should be paying attention to with junior explorers is any resource calculations or preliminary economic assessments that were done at higher gold prices. Investors should really be paying attention, because a resource, they may have a nice resource, but perhaps it was done at $1,500, $1,600 gold. Or similarly with the PEA, done at $1,600, $1,400 gold. It changes now that we're down at these levels. So yeah.
It's getting a lot better now, like when someone comes out with a PEA or a feasibility study now, but there's definitely that period there as we're transitioning from the higher price to the lower price, where you notice a lot of people are still coming out with studies at $1,600 gold, and they're saying, oh yeah, we got this great, we're going to get a great return on our investment, and we're going to get, payback will be in so many years and that kind of thing. And you're like, wait a minute, gold price is $300 lower than what you did this study at. Nothing is valid anymore. So, and some of the companies are still promoting their old statistics. So investors definitely need to be aware of that. That's a great point.
Yeah, that's a great point, and I've noticed that as well. A lot of management teams out there are a little too optimistic on when they do their scenario analysis on their mine that they have. So investors out there should not take their word on what they have, because 9 out of 10 times when they go into development, there's always something that goes wrong, and it sets them back, and the cost goes up. And so investors should be wary when they see their scenario analysis and see, IRR of 30%, payback period of 2 years. They're going to, go from 0 to 2 million ounces in X amount of years. So that, it never goes to plan. And based on my experience, so investors should be wary of that. So also, we haven't mentioned royalty or streaming companies. I don't know if you guys cover those type of companies, but what is your opinion of those? I think those type of companies are great to invest in if you don't want to take on the operational risk that normal mining stocks take on.
Yeah, absolutely. I think royalty companies are great, and I think they'd be a good long-term hold when these metal prices rebound. Franco-Nevada, it's a great company. Of course, it's a large one, but it's a great company. Silver Wheaton, Sandstorm.
Yeah, and we covered an interesting model in our top 10 report for Eurasian. If you had a chance to check that out at all, Eurasian is a really interesting company because are you familiar with the prospect generator model as well?
Yes, I am.
Okay, so they're combining that with the royalty model. So instead of a typical prospect generator where you would, you'd have a major or a mid-sized company work their way into your project for a percentage ownership, they do it by keeping the royalty on these different projects that they stake, and they stake dozens and dozens of projects. And their technical expertise is in the very early stages. So they've put together this big portfolio of projects, and then they keep the royalty on them and let all the other guys do the work. And it could create a really interesting situation for them moving forward here. So it's kind of an interesting one to watch there, just because it's pioneering. It's kind of like a royalty model, except with another element of potential growth in there as well.
What's the name of the company? And for listeners out there that don't know what Prospect Generator is, do you mind explaining the business model?
Yeah, for sure. So the one that we're talking about is Eurasian Minerals. I think it's next on the venture here in Canada. I'm not sure if they're dual listed. But the Prospect Generator model specifically, or a project generator, depending on who you talk to. First, I'll give a definition of sort of what a typical junior exploration company would do. So typically, they would have one core asset or maybe two core assets. They're doing private placements, getting investor money, working on that asset. So you're doing the geophysics, you're drilling, you're building up, trying to figure out the what the geology of it is like, and you're focusing on that one project. But what tends to happen is, if it turns out that the project isn't economic, or if it turns out that there's political risk or any of these other factors which can sidetrack a project, you might go from having a great project to having nothing, or you might go from having something that has high potential to having nothing. I mean, if you just look at something like the Pebble project, right? They have the world's biggest deposit there for gold and probably copper as well. But because of the circumstances, because of where it's located, they're just probably never going to be able to build it. So if you look at the value of Northern Dynasty over time, they pretty much lost everything. And that's the type of risk that the project generator is trying to get away from. So what they do is typically they'll have a wide variety of projects, usually in an area that they have some expertise in. So, for example, maybe it's in a certain geographic region, or maybe it's a certain type of mineralization that they're used to. And what they do is they put together a portfolio of these projects, and then they, instead of using their capital to work on those projects, what they'll do is they'll bring in, or maybe they'll do some initial work on them, that kind of thing, to prove them up a little bit, but then they'll bring in bigger companies that have more money to spend, and they will come in and do work into those projects for a percentage. And so basically what you get is you get a whole bunch of positive optionality there, because you're able to have multiple projects that all have potential, and you're able to have other people working on them for you, so you don't have the dilutive risk of having to keep on raising money and spending it in places where you're not getting the benefit. And you still have the upside on these projects. So it's an interesting model, and it's definitely something that's worth looking at in this type of environment right now, where capital is hard to come by. So yeah, does that explain it?
Oh yeah, that's a great explanation, Will. Thank you. And so one final question before I let you guys go. Now, a lot of commodity investors on Main Street has been invested in the gold and silver space for quite a few years now, and with the low gold and silver prices, there's very little money. Well, if you pick out the right stock, there's some stock out there that made good money, good returns this year. But for the most part, a lot of them did not do very well this year. And I think a lot of them are growing impatient and tired of the negative return. So I want to ask each of you guys, what advice or tip you have for people out there that getting tired of seeing the low gold and silver prices and the negative return in their mining stocks?
Well, I would say it depends on the age group of the investor. Obviously, shorter time frame for investing, you can't really stomach these lower prices, whereas if you have a longer horizon, you can hold on and wait for the gains. I mean, I know over the long term, stocks have outperformed almost all assets over the long term. So if you're a long term holder, I think you'll be fine. And I think these levels they're difficult, but they're attractive. Many companies, their operations and the projects in the pipeline make them very attractive at these levels. But the great thing is, with Tickerscores, it weeds out a lot of the weak companies in an environment like this. And a product like Tickerscores can reveal stronger companies, and those are the ones you want to gravitate towards. Because it's anybody's guess how long this market will last. This poor market conditions will last for.
Yeah, I'd say on my end, I think the most important thing to think about in terms of a level of comfort is that this is a market that's traditionally been highly, highly cyclical as a nature of the amount of capital that has to go into it, and that just creates, and the amount of time that it takes to actually build a mine, which is even longer now today than it was 10, 15 years ago. Now you're looking at probably like 20 years to build a mine, realistically, from the very beginning of exploring to proving it up to having to go through all of the hoops that you need to go through to actually building it. And, it's just the way the market works, being so cyclical, is that I think that, if you're a smart investor and if you think with your head rather than your heart, and you have a long enough time horizon, I mean, like, the potential in the space is, for me, that's why I'm in the space. I think the potential is incredible. I think it's something that you can't get anywhere else, and that the markets are, just that volatility is a good thing if you can stomach it, because you can, at times like right now, if you have the cash, you can be loading up on some of these companies, such as the ones that we're finding that we think have great potential in the future, companies that have great management teams that have statistically proven that they're better in a lot of ways than other teams. You can look at companies that still have healthy balance sheets, even balance sheets in today's environment, and companies with projects that are going to be, the next big mines of the future. You can look at those companies, and when you look at their pricing and their value, it's just amazing. It's just something that is really difficult to find, and you'd have to go back to probably the early 2000s to find similar levels, and we all know what that bull market was like. So if you can stomach it and you can get some of these companies in right now, if you can hold them in your portfolio and obviously pay attention to what the market is saying and pay attention to what these companies are doing, but realistically, I would just be holding these companies, making sure that they continue to be good, well-performing companies, and just waiting it out, right? It could be 6 months from now. It could be 4 weeks from now. It could be 4 years from now. But the reality is that because the market is so cyclical, it's so volatile, it will go back up. It's just a question of when and what causes it. And that's really the truth based on all data that we have. It goes up, it goes down, and when it does it makes very strong moves either way. And I think based on the levels right now, I don't think it's going to go down that much further, if at all. And but the potential upside is there to be life-changing. So people just need to keep that in mind. And I think that, as Aaron says, it does depend on your time horizon. But for anyone that has at least 5 to 10 years of time horizon, I think that there's going to be if not a small uptick, a really large uptick. So,
and yeah, I agree with you there. I think the commodity sector, the energy and gold and silver, is probably one of the few undervalued sector right now. If you look at the stock market as a whole, because everything else is pretty much overvalued, especially the technology sector. So anyway, Jeff and Aaron, thank you for your time. And before I let you go, why don't you tell us about Visual Capitalist and Tickerscores.com before I let you go?
Yeah, sure. I'll just do a quick brief summary. Visual Capitalist is a free website for investors and people interested in business. Basically, we do everything using infographics, so it's all highly graphical and intuitive that way. And we cover wealth, different high-growth sectors. It's just a place to learn and gain knowledge on investing in different sectors. And then Tickerscores, as we talked about earlier, the goal is to provide a transparent and empirical system that will allow investors to really be able to do some quick due diligence on precious metal stocks. Eventually, we'll be covering all commodities, but for now, we're starting with, we cover over 450 precious metal stocks. And that's just a place to to really to be able to compare these companies against one another and to really figure out the ones that stand out. And there's all kinds of different components to that that we do. We have a weekly trends newsletter and a stock of the week that gets sent out to subscribers. We publish each quarter the 10 companies in depth in about a 90-page report, the 10 companies that we're looking at that we think have the most upside potential over the short to medium term. With that report, we published the last one the beginning of September, and within a week, one of those companies that we listed was taken over for a 42.5% premium by Agnico Eagle, one of the majors. So we look for short-term catalysts that have the potential to really change the whole share price. So that's sort of a summary of some of the stuff that we do at both of those companies.
Okay, great. Well, Jeff and Aaron, thank you for your time, and hopefully you can come back on again soon.
Sounds good. Thanks so much, Mo.
Thanks a lot, Mo.